Behold, and welcome to Happy Hour with the Lincoln. We are on episode number 41, where every week I will answer your stock market related questions while I share some of my favorite libations with you. Now you may ask, what is in this glass? Well, after this week, I've been feeling a bit Irish. I've been feeling a bit scrappy, a bit frisky. So what better way to unwind than with my favorite Irish whiskey, a little bit of Jameson's. That's right. Jameson's. Sorry, I'm just trying to entertain you. I'll move on. A little bit of Jameson's. I think I lifted this from Delta. Well, I didn't lift it. It was free when I was going to Africa. Maybe I just... So anyway, we got some great questions that we're going to talk about today. As always, if you guys have questions related to the stock market, your trading, or stuff that you need help with, right here's the email, support@thelincolnlist.com. I'll do my best to get it on some of these upcoming episodes. And if I don't, I will at least get back to you as soon as possible. Now, one of the things that we're going to talk about here today, oh, wait a minute. Let me do the shameless plug. Don't forget our live trade room if you need help. So one of the things that we're going to talk about here today is in the last, I think it was the last happy hour. Maybe it was the week before. I don't know. But a couple of you had mentioned about when I told the story about me working in a motorcycle store and trading and making that transition from that business into what I'm doing now, which is stock trading. How did I do that? I know some of you are trying to make a transition from your 9-to-5s or your jobs into the stock market. What's the best way to do that? So we're just going to jump right in here to the first question. Last week you were talking about your transition from bike store owner to trader. The question I wanted to ask is, how should someone make that transition? How much time should we devote to trading in the beginning? It's hard with another job. Okay, there's a few questions lined in this question. So let's just talk about how to make the successful transition from whatever your job is now to trading. Now, when I mentioned it, I think it was in the last week's happy hour or the week before, I was fortunate enough that the hours worked well for me because when I owned the bike store, I worked from 11 o'clock Pacific time until 7 p.m. So I had that morning, which was 6:30 a.m. Market opens at 6:30 a.m. on the West Coast. So I had from 6:30 a.m. till about 10:30, which is a big portion of the day. Then I could go to work. So that was a blessing in disguise for me. If I would have been on the East Coast or something like that, where those hours overlap, it would have been a much more difficult process, and maybe I wouldn't be where I'm at today. Now, if you're living somewhere where time is in your favor, you have a job that works in your favor, like I did here on the West Coast, or maybe we have a lot of people in our trade room from like Europe, where their hours are like from 3 in the evening, some even later than that, up until like midnight or something. I think it was like that when I was in the United Kingdom. I can't quite remember. But if you have something like that where you can have a job during the day and then work, that's going to make it a little bit easier. Or if you just live anywhere in the world and you can work around those hours. So if you're going to make the transition from wherever you are to day trading, I'd say it's an absolute must that you are available from 9:30 a.m. East Coast time when the market opens, at least for the first 2 hours. That's where most of your money you'll experience over time will be made. That's where most of the opportunities are. That's where most of the volatility and the volume, and that's going to be the best place for you to learn. So if you want to pursue a career in day trading, regardless of what part of the globe you live on, you will have to have that 9:30 a.m. Eastern time to about 11 o'clock-ish, somewhere, maybe, 11:30, somewhere in that neighborhood, the first 2 hours. You'll need that in order for you to stand a good chance of being successful. Now, if you're someone that does not fit, and that's something that you cannot do, and I understand there's so many people that you're working at a place, you just can't get around it. One thing that you may want to look at is swing trading or momentum trading. Now, what this is, it's shorter term trading. And instead of you day trading in and out several times a day, you're holding positions overnight. You're giving them a day, 2 days, a week or so to work. Now, it's a different strategy. Many people do that as a sole means of living. I know several swing traders. It's not my forte. It's not where I excel. Day trading is where I excel, but that's just who I am. However, I would go that route because what you can do is when you come home from work, you can study the market. You can play back the market in real time via stuff like Thinkorswim, and they're on demand. Many brokers now have that where you can replay the market, see what it looks like in real time. You can study your charts, and then you can put your orders in the next morning or set your limit orders, your stop orders, and you can make your trades that take you about 1 hour to 2 hours every evening to do that. So if you're, I know it's hard, as it was said in the end of this question, but if you really want this to be your career, as I said in the past happy hour, it was a bitch getting up at 5 in the morning, working from 6:30 to 11, then working in a store, then wrenching on bikes until 8 or 9 o'clock, then studying until midnight. Yeah, it was a pain in the ass. It was a big pain in the ass, but that's just what I wanted to do, and I was willing to make that sacrifice. So somewhere along that line, you'll have to make the sacrifice. You either have to work around those hours and be available. If you want to be a day trader, you have got to be available, I think, between opening and the first 2 hours. If that doesn't work, then start going in, start doing your studying in the evening, start looking at your charts, and start doing swing trading or momentum trading, and you could be very good at that, and then you could quit your job. Now, when I say quit your job, I mean when someone's talking about the transition, I think that's what you really mean is how do you know when it's time for you to go on your own? You can't do that unless, I say bare minimum, you have to be 6 months profitable every single month, and you have to have enough money right there to pay your current bills. So if you're making $5,000 a month at your current job, you need to make $5,000 a month for 6 straight months before you can go on your own. Or you just have to have a big chunk of cash. Maybe you're retired and you're going into another career, if you got another form of income or something like that, that's different. But if you're just a standard 9-to-5er that's paying a mortgage, paying some bills, and you want to pursue a career in day trading, that's your only options. You will have to find a way to get into those hours, learn how to swing trade, or to make that transition. I would not, under no circumstances would I ever do it until you could string together 6 straight months of whatever your current income is or whatever your bills are. If you want to take a small pay cut because you want the freedom, then that's fine. But you have to, I think 6 months at minimum of whatever. Like if your bills are $5,000, 6 months, $5,000. If you can do that, then you're probably ready to move from that career into trading. So let's move on to question number 2. In your last video, you were talking about the VWAP on your charts. There were other lines. What were those lines? Were those Fibonacci's? Okay, no, they were not. And recently I just did a video, and if I always remember and can remember, I will post the video here where I explained exactly what those lines were because many people ask. That was the 10, the 20, the 50, and a 200 simple moving average. So somewhere on this screen, I shall post that video where I talk about them. I do not use Fibonacci cycles. I can barely pronounce the word Fibonacci. And it got a lot of stuff. We talked about this when it comes to technical analysis. And this takes a little discovery process from every trader. Some of this stuff can be very complicated. Floor pivots, Fibonacci cycles, MACDs, Elliott wave theories, that kind of stuff. If it works for you, one rule I always want to make is I'm not judgmental by anyone. If you found something that works for you, do it. Even if that means throwing darts. If you figured out a way to be successful and consistently be successful, don't let someone else try to change that for you. You can build on that, but don't let anyone change it. One of the things that helps me is I try not... The best decision I made was to get rid of all indicators and just use support and resistance. I've said that before. So when I was really confused back in 2002 and 2003, that's what made a difference, was just getting clean looking charts, focusing on price. That's what I had to do, was go back and look at price. Where do people buy? Where do people sell? Then once I started to get a little bit better at it and started getting to a rhythm, I put in a few moving averages, I put in a VWAP, and like I explained in those videos, I hardly ever use those for an entry. I usually mainly use them for an exit or gathering clues. So like I said in that video, if you guys haven't seen it, I'll just touch on it briefly. So when I'm looking at a moving average or something, that's not going to be my entry, but maybe I'm looking for a price discovery. So if a stock is there and I start to see some action, then I'll try to correlate the 10 moving average with maybe a past support area, if that kind of makes sense. That's what I'd look for. I just look for clues as to try to gauge the sentiment of a stock. And I know some people rely on them, and if they work for them, far be it for me to tell you. But no, those lines are not fibs, man. They're not fibs. They're just 10, 20, 50, 200 moving average, and I did a video on it. So that's what they were. We move on to our last question, which is no stops. In your last happy hour, you said you did not use stops. Every trader I talk to says risk management is number one. How can you have risk management with no stops? Well, first of all, I'd like to say I didn't say that. I said I use mental stops, not physical stops. But we all have something that I'd like to bring back to the fray. I also did a video on that. And if I do remember, I shall place it somewhere here. It's called the GTFO number, the get the out number. So what we do is the stocks I trade because of the way they behave. This is one of the things when you start trading the same stocks over and over again. If you trade a new name every day, this is going to be difficult, but this is one of the benefits of traders, why you see a lot of traders trade the same stocks over and over again, because you learn how that it's almost like it's a person. It's got like a living, breathing person. It's got its own attitude. Like Tesla. Tesla's got attitude, right? Tesla's got some tude, you know? BA doesn't always have attitude. Doesn't always have it. NVIDIA sometimes has attitude, but it's not like bad attitude like Tesla. It's just like cranky old 3-year-old toddler kind of attitude. So you learn this about these stocks. That's what helps you in the very beginning doing the important essentials like stops, position size, shaking out, dealing with that stock's behavior. So because they're generally more expensive and they'll move around a buck, then I like to, first of all, use a lower position size, which I've mentioned several times. Rather than going in heavy on that, I'll give myself the flexibility in the room to work the trade a little bit. So I'll use a much deeper stop than most, and then I'll work the trade. Now, when I say a mental stop, is I'll realize at some point 2 events will happen. Either I realize that I will not be able to make this trade work, that I can't get to my break even, or I'm struggling with this trade, or it looks as if I have made a poor decision, and I'll just take the loss where it is. I didn't put a physical stop loss, but I'll work the trade. If it doesn't work out after I do a few of the things that I like to do, like VWAP, bounces, or whatever it may be, then what I'll do is I'll just cut it. Now, let's say something happens in an extreme emergency in this, like this market's sometimes doing. Like I think as I'm doing this right now, the market's dumping after hours. If you're in a situation like this, we all have what we call as a GTFO number, which is whatever it is. And that's when your P&L hits a certain amount and you cut it. You just say, that's it. That's my max loss I'm willing to take on any trade. And how I came up with that, I think if I can remember in the video, what I normally use is anywhere from 3 to 5 times the amount of your average win. Now, that's not every time you lose, you're not going to GTFO out every single time. I'm sure you guys understand that. That's just an extreme situation where something's gotten out of hand on you. You like deer in headlights, you're freaked out. You just got to hit the eject button and just get out of the trade. Maybe it comes back, maybe it bounces, but you got to protect your capital first. So let's say your average win is $500. That would be $2,500. So I would say max $2,500 to $3,000 would be your worst case scenario on every trade. Now, to maybe answer a question that some of you might be asking is, how many times have I used a GTFO number? Maybe 2 times a year. 2 times, 3 times a year, maybe. So it's not a common occurrence, but there's a handful of situations that will come by in a year that that will happen. You'll be pressed down there. You'll get close to it, or you'll exceed it. So it's not, like I said, it's not something that you're going to do every single day. It's not like you're going to make $25 on every trade and then all of a sudden take a $3,000 loss. I know there's people that are doing that, but that's not what it's about. So use that GTFO number. Number 1, I do use stops. I use mental stops because the stocks that I trade, they move around a lot. So if I put a hard stop in there, I'm just going to get hit every single time. It does not work for me. And like I said in the last couple of videos, to compensate for that, lower the size, give myself a little bit more room. That protects capital. In the event of an extreme circumstance, a market crash, or something that really, really goes against me real fast, you use that GTFO number. So I hope that kind of made some sense. Now, on that note, I'm going to sign off. I'm no longer Irish. I got no Irish in me at all. I just like using this accent. It's not very good. Kind of reminds me of Train Spotting. If some of you ever saw Bigsby, whatever his name is. Look it up. So I'm going to finish off this last piece of Jameson here. And as always, if you guys have any questions, you know where my email is. If you need help, trade with us live. Thanks for watching this video. And until the next happy hour, I say cheers.